Yes, Kunal, good morning everyone. So let's start, friends. I hope you have revised well all the concepts of and all the techniques of capital budgeting, right? See, first thing what you need to remember, it's all about comparing cash inflows and cash outflows, right? We'll take a quick go through the things that we have discussed and then we will continue, right? What is the important thing? It's a capital expenditure decision. They are all irreversible decisions. Means theoretically you can reverse, but then you incur a lot of losses. So not a great idea. So take it sensibly, take it after doing a lot of studies. So what we have to ensure that whatever outflows that are going out, like whatever money we are spending, that cash should get recovered. So what we do? Simple. We compare cash inflows and cash outflows. What is the peculiarity? Cash outflows are immediate and certain. Right? If I have to purchase a machine, I have to spend. Without that, nothing can happen. Right, friends? So cash outflows are certain and immediate, but cash inflows are what? Are uncertain, and that will happen in future. Correct, friends? So we have found few techniques, right, which will help us to evaluate a particular project. Right? Okay. Then what we say, okay, there are some techniques which you can say they are traditional techniques. They don't consider what time value of money. The first such method we discussed was payback period. Correct. What is the simple thing that we do? We compare the initial investment with the annual CFAT and find out how much time we will require to recover our money. And when it comes to recovering our money, recovering our cost, then as simple as that, the earlier the better. So when we go with payback period method, what we do, guys? We just select that project which has the lowest possible recovery time. Correct? You remember this? Okay. Later on, we criticize this method also, saying that number one, it ignores time value of money. Number two, saying that it focuses only on what? Recovery of the cost. We also discussed that see, long run aim may not be recovery of the cost. Once you recover the cost, the next long term aim is always what to earn profits. Correct? So it might also happen that a project which is taking a long time to recover may have a long run of profit also. You never know, right? Okay. Then we came to one more traditional method that is without considering time value of money, and that was ARR. Remember, accounting rate of return, or also known as what? Average rate of returns. See, guys, whatever methods are there, I had told you very specifically that this is the only and only one method which focuses on what? Profitability. Correct? Rest all methods make use of cash inflows. This is a single method which focuses on what? Profitability. Correct? Then what formula we discussed? Average NPAT, average net profits after tax, we'll compare with what? We'll compare with initial investment. Or you can also compare with average investments. Right? Opening is an outflow, closing is an inflow, the middle value of that is an average value. So start with original investment, end with scrap value, divide by 2 is an average investment. Okay. And then I told you, see, you may go with original investment also, you may go with what? Average investments also. But at least when you're comparing the things, suppose you're comparing three projects, then at least in one discussion during comparison, don't change the parameter. In fact, I had reminded you about the accounting ratios also. Let's see, guys, in a particular question, in a particular year, we are unable to calculate average stock because opening is not available. We do it on closing stock. Then for the remaining years also, even if you are in a position of doing average stock, please don't do that. Because in one year you keep closing stock, in another year you keep opening stock, or an average stock is not a great idea. Remember that? Okay. After discussing this, we started with time value of money. Am I right? After discussing this, we started with what? Time value of money. We discussed about uh, compounding, we discussed about discounting. Then we had our own time calculating present value factors. We talked about some people not getting in our calculator, all those possibilities. Right? I hope now everybody can manage to get it on their calculators. Right? Huh. Yeah. Yes, yes. I found out that calculator. In case like you still cannot manage to calculate, we can right now also we can talk about it. Okay. So after that, the first method that we discussed was what? Net present value method. Right? Okay. Net present value. Net value. Net means something gross minus something. Net, you understand? In net is not the net. I'm talking about bird net, fish net. I'm talking about gross and the net. Right? So net what? Present value. So what we do? We take the inflows and we subtract the outflows. But the yeah, mosquito net, correct, Somesh. Thank you for making the addition. Meanwhile, we talk about the gross and net concept. Okay. So net of what? Inflows minus outflows. Only thing is that when we are doing net of inflows, we are converting them into present value. So we just don't say inflows, we say present value of cash inflows. Right? Okay, then how to bring it on the present value? We had a discussion that, sir, we are always taught that some number is given in the question whose present value factors we use. And then I convinced you very hard that you have to use present value factors of what? Of KO. Correct? You have to use present value factors of what? See, this is K and this is O. K, right? Correct. What is the whole idea about it? What is the whole idea about it? See, my KO is 15%. I have to ensure that I'm earning more than 15%. Correct? I have to ensure that my earnings are more than what? 15%. Okay. How do we do that? Future cash inflows, discount them by 15%. Still, they are higher than your cost. Means you have what? Made them more than 15%. Okay, guys, we need to remember what we have covered up in PVCI and PVCOs. What we have said, PVCO is a cost, immediate, on the spot, right? So it will include cost of the project. How many things we wrote? Do you remember? You can show no by sign like this, like this, like this, like this. If not sufficient, you can make use of feet, fingers of leg also. How many things we wrote? 3 things. Correct, friends? Which 3 things? First is the cost of the project. In case there is any installation cost, and also one important thing, amount blocked in permanent working capital. Explaining that permanent working capital, I took a simple example of one, the ice cream shop that we had discussed in the estimation of working capital. There we understood that a shop is there, fine, that's a fixed asset. A box, ice cream box is there, refrigeration box is there, okay, that is also fixed asset. But ultimately, in that refrigeration box, some ice cream I have to keep day in and day out. Whenever a customer comes, I should have that. So that 1 lakh rupees of ice cream I bring on day one, and I keep 1 lakh rupees invested in my permanent working capital. Remember that? Okay, fine. Then we talked about present value of cash inflows. That we said, see, any business, the first most important thing is sales. By doing sales, we'll get some cash inflows. So we will convert the first present value of cash inflows over there. Second, we discussed that, see, when you buy the machine, you spend the money. At the end of the project, what will happen? You will salvage out. That means you will sell out that machine. You get some money, which we call a salvage or scrap value. Correct? But the thing is that, guys, if the project is of 5 years, you will get salvage in the first year. People are only in the nodding mode. Yes, sir. Yes, 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 sir. If the life of the project is 5 years, how will I get salvage in the first year? In remaining 4 years, what do I do? Dance in water around the machines, box. If I if my project's life is 5 years, I will sell it, scrap it at the end of the 5 years. So salvage will always come in the 5th year. What you will have to do? You will have to bring it to today's value. right, friends? And then one more thing, without fail, release of amount blocked in working capital. Don't ever forget that. Clear? But even the release of amount blocked in working capital will happen in the last year. Correct, friends? It will happen in the last year. That's why what we will have to do, people, we will have to consider it at its present value, multiply by the present value factor. Right, friends? You understand? Remember all this? Okay. What we had discussed, that's a decision rule. If there's two or more projects, then how to select a project with a higher NPV? If there are two or more projects, how to select them with a higher NPV? Okay, if it's only one project, then NPV positive, you select. NPV negative, you reject. NPV zero. NPV zero means what, guys? PVC or PVC or both same. No profit, no loss. You are okay with it? Do it. Suppose you are an NGO, you do it. Suppose you are a government organization, not bothered about profit, do it. Depends, right? That's why what we say neutral. Who will decide? The company will decide. Okay. Fine. So let's continue further. What do you want to ask? You want to ask Sri something? You're doing like this, like this. I thought you were asking something. Okay. Okay. Fine. And I think we had written one important note. If the life of the two projects is not same, get it done annualized NPV. I you remember okay, what I told you. See, by virtue of the life of the project, suppose one project is having only 3 years life. Kamalika, good morning. Kamalika slept or what? Kamalika listening, na? Babaji Pravachan, early morning. Every morning you start with the laptop. Keep some do, diya, agarbatti. Start. Everyone listening now, guys. Nobody sleeping. My voice is so sleepy. Put 1 o'clock alarm. Come on, if you feel so. Sir, 11:30 we'll get up. No break. Will give no. We work on only two bases, sir. One is the break time. Other is the lecture ending time. These are the two places of motivation, right? For which we survive. So people, jokes apart. Come on, come back to this discussion. See, if one project is of 3 years, another project is of 10 years. Then by virtue of the long life, the project with 10 years will be having higher NPV. So what to do? Annualize it. Okay, while annualizing, what will you do? Divide by number of years or divide by PVAF? PVAF, second option. Because if you divide by number of years, again you end up doing the same mess. You ignore the time value of money. Don't do that. Correct? Then we discussed IRR. IRR was super. Right? Trial, error, and interpolation. Right? And interpolation in simple words is what? Cross multiplication. Remember that, guys? Okay. Okay, fine. So let's move ahead. After that, yes, after that, have we covered any method? Have we covered profitability index method as well? Yes or no? We've covered, right? I think that is a place where we started our last lecture. Capital rationing and profitability index is what we wrote. Correct, guys? Remember now? Okay. What is this capital rationing? See, when you're running short of money and all projects are positive, then you have to rank the project. Okay, how we calculate PV, how we calculate profitability index? PVCI upon PVCO. Correct, friends? Remember that, right? Okay, so we can rank the project based on that. Okay, if we have done this, then we have definitely done discounted payback period also. Right, friends? What is the difference between payback period and discounted payback period? Payback doesn't consider time value of money, right? So payback works on what? Cash inflows, raw cash inflows coming every year. payback period. Correct? And if it comes to discounted payback period, guys, convert the cash inflows into PVCI and then calculate discounted payback period on the basis of what? PVCI. Remember, right? These many methods we have done. So, guys, I took some revision. I hope it added to some information, right? Okay. So, sorry to take 15 minutes of your life, but so let's continue. Okay. Yes. So now we will go ahead with the next questions. Okay, people, let's start with question number 9. Question number 9, otherwise, is very simple. Okay. It's on the same guidelines. NPV we have to calculate. Let's come to question number 9. Okay. Let us start. A company is considering the proposal of taking up a new project which requires an investment of how much? 400 lakhs. Investment of how much? 400 lakhs. So we will call it PVCO. Right, friends? Hope you remember. I make you write on the notes a lot. I spoil your books. Please do that for me. Keep writing. Okay. The project is expected to yield. Oh, my common question. Pay attention. Pay attention. Don't sleep. And don't go anywhere. Following earnings before depreciation and tax. Now you know I'm going to take you to the railway station and ask you which station is this. Okay, fine. Thank you. What is this? What is this words over here, guys? Check those words. Earnings before depreciation and tax. Okay, we are going on the railway station. Where is it? Finished or what? Ah, it's there. It's there. You know. Okay, you guys are replying. You could reply just with the station number. No, why taking so much trouble typing so much? Uh-huh. Guys, what is this? Everybody is answering only correct answer. How? For the sake of giving wrong answer, don't give. Wow, wow, wow. So nice, so nice. 100% correct. Success ratio 100%. Really sharp. Thank you so much. Okay, I am getting all the answers correct. So confirm now with the 100% majority we are over here, right, guys? Net profit bought before depreciation and taxes. See, I've been repeatedly telling you guys. If we make a wrong guess over here, we are perished. We will be discounted till our NPV becomes zero. Right? Make sure that you don't make a mistake over here. correct? And that's the only way of identification that we go on reading this again and again. Fine. So everybody confirms this. Step number 4 we are at. Minus. Okay, let's go ahead. So now we will continue our reading. So for 5 years, earnings are given to us. So we are final now. This is our net profit before depreciation and tax. Okay. Cost of raising the additional capital is 12%. Guys, KO, right? And assets have to be depreciated at 20%. That's fine, sir. But now this time they're on WDV. Okay, they're on what? WDV. Okay. Then scrap value is to be taken as 0. Scrap value is nil. Tax rate is 50%. You require to calculate net present value of the project and advise the management to take appropriate decision. Guys, all of you understand that KO is how much percent? 12%. If KO is 12%, then my only rate, and I'm asked for NPV, then my only rate of concern is this. Yes, right? You have very clearly told you are required to calculate net present value of the project and advise the management to take what appropriate decision. So we will calculate net present value. Then, sir, why these rates are given, the other rates? So some people at least think, nah, the other rates are given. No. So maybe they may be given for IRR. So some people will calculate IRR. An examiner is very happy that you wasted your time. Is it required people? Is question asking us to do an IRR? No. Then why we should get it? We'll just calculate one NP. Okay, fine. But listen. This is going to make some dramatic changes in your life, huh? WDV. So for that, you first see the explanation that is given by me. Then you come to the solution part. See, very important. Very important. Guys, first read it, then copy it. Okay. Tax payment on profit on sale of fixed assets or tax savings on loss on sale of fixed assets. See, if the WTV on the of sale and the WTV are different, then there might be a scenario that you may either make profit on sale or you may either make loss on sale. If it's a profit on sale, then you have to pay tax on it. If it's a loss on sale, then what? You might have incurred, you will save some tax on it. Okay, so understand. See, in case of WDV, guys, I repeat my words. In case of WDV method of depreciation, make sure to compare WDV as on date of sale with the salvage value. Okay. Find out the profit or loss. In case of profit, tax is payable, outflow. In case of loss, there will be tax savings. That is what? Inflow. Okay. Remember this. Now I will, when we will calculate further, I will show you what am I mean to say. Okay. First, let's calculate. Okay. So we are confirmed that we are going with station number 4. You see. Check. We will write it. Give me 2 minutes. Let me explain this. Then you prepare the format also. Then you write this also. First, you taking PVCO, cost of the asset. Then for PVCI, as I told you, we will have to make it for 5 years. And then NPVTT till we reach till where cash inflows, and then it's present values. It's your income statement sort of. Okay. So what you do is keep this much ready. Then we will solve it together. Keep this much ready. It will done. Okay, so shall we start substituting? Shall we start filling up the values? Huh? Okay. Let's start now. Sure. Actually, before you proceed further, have you calculated the depreciation properly? Let me just do one thing. Let me copy that file one. Capital budgeting. Question number 9. Okay, fine. So let's solve all this in lakhs as usual. So here you will write 160, 160. Then we have 180, 180, and then 150. Okay, friends. Then how do you calculate? Find out. See, 400 is the cost. So into, oh, there is no, into 20%, right? That gives you 80. So first you write 80. Then you say, just let me check whether it happens over here or not. And it doesn't happen in this calculator. So you know what is to be done, like 400 into 20% gives you 80. So that you will first write as a depreciation over here. Immediately do what? Minus equal to. So that becomes your opening WDV for the next year. Then into 20%, 64. Okay. Then minus equal to what becomes 256 into 20%, 51.2. Right, friends? Please follow this. Okay. Array, no big deal. Okay. Please follow this. Then again into 20%. I got it 40.96. Okay. Minus equal to, and again whatever it is into 20%. Just confirm 32.768, guys. It's in lakhs. So I'm not doing any rounding off. Okay, guys. Hello. After subtracting that, please understand, please listen to me. We are going to mention in rough over here. Closing WDV. Everybody confirm with me. 131.072. Let me see your faces. Hello. Is this final value confirmed? 131.072. Sure. Na? We will use it while calculating profit or loss. Write it over there. Somewhere in rough, you keep it. I hope everybody understands closing WDV. Correct, people? Okay. Okay. Fine. So we are good to go. And I always suggest you, right, complete for 1 year at a time. That actually makes it very easy. That actually makes it very easy. Okay. So it becomes like the numbers are available in your calc, So 160 minus 80 gave me 80 over here into 50% gave me 40 over here minus equal to give me this answer. I will add back the depreciation. So 80 I add back. So plus 80. What, so you can do this orally also. Not for everything. Okay, I'll copy all these 12% factors, guys. I'll copy all these factors. Given in question, I don't be smart. 0.89, 0.80, 0.71, 0.64, and 0.57. Right? So this 120 into 0.89, my final answer is 1066. Not over. This is the last one, 157. Yeah. Anyways, if I multiply this, I get 106.8. Right, friends? Yes, correct, Shruti. Look, okay, don't post, that is fine. Just complete the calculation. See, you understood that, you must have understood that if you complete at one go for 1 year, then the flow comes on calci. So it's like every year you might first multiply by something, then by something. Don't do that. Don't do it stepwise, do it year-wise. Becomes rather easy, right? 160 minus 64. I got 96 into 50%, so I got 48 minus equal to, again I got 48 only. Add back 64. I got 112 to 0.8, 89.6. 180 into, 180 minus 51.2. I got 128.8 into 50%. I got 64.4. Obviously, minus equal to will be the same. But do it. Because you can easily add up 51.2 into that. Add up 51.2. So you got 115.6 and into 0.71 gives you 82.076. 82.076. Okay. Then 180 minus 40.96 gives us 139.04 into 50% is 69.52 minus equal to gives me 69.52. Add back 40.96 plus 40.9. Good morning, madam. 110.48 into 0.64. 70.7072. Right, 70.7072. It's in lakhs now. 150 minus 32.768. 117.232 into 50%. 58.616 minus equal to will always come same. 58.616. Add back 32.768 plus 52.768. 91.34 into 0.57. 52.0889. Digit, isn't it? Yes. Correct, friends. Very good. Okay. Now listen. This is all your cash inflows. Correct. Yes. I was to come to it. See, year 1, year 2, year 3, year 4, year 5. So what we will have to do? We have to take the total of all this, right? Okay. So total of all this we will take this plus 106.8 plus 89.6 plus 82.076 plus 70.707. Oof. 401.27208, right? PVCI. PVCI also will keep it up to 4 digits, guys, because it is always safe practice to do that. Okay, it's in lakhs, no? It's in lakhs. Yes, 401. Correct, correct, correct. 401.27208. So 2721 is fine. Okay, done. Yeah. Wait a minute. Now this is something. See, now listen to listen to. We are going to talk about what? We are going to talk about profit or loss on sale. Okay. First, what we need to do. Okay. What is a WDV on date of sale? WDV on date of sale, guys. This rough calculation 131.072. 131.072. Any salvage expected is clearly written in the question. This is getting my point. I hope you're getting the point. So what has happened over here? It's a sheer what? Loss. Okay. It's a total loss of how much? 131.07. So guys, what will happen? It will be tax payment or it will lead to tax saving. Tax payment it will lead to tax savings. Tax savings. I'll make you understand further. Listen, listen. This loss on sale you will write on the P&L debit side. Correct? Because of that, your expenses will increase. Means the debit side will increase. So your taxable profit will decrease. As you guys do the same thing for tax savings on interest now. So when you write interest as an expenditure to the P&L debit side, what happens? Automatically, what happens? Your taxable profit reduces and your tax reduces. Okay. So will be tax savings, which will be what? Loss into tax rate. So 131.072 into 50% will be saved. 131.072 50% comes to 65.536. Okay. Yeah. Hello, guys. Tax savings will be inflows. Just talk to me first, guys. This is a new thing that we are doing. So don't be so busy writing the things. Listen to me first and talk to me first. Tax savings would be inflows. Do you agree? Everybody? Sure. Now you need to tell me this is happening in which, this will happen in which? Correct. Yes. High five. This will happen in 5th year. Right? So take this as it is or convert it into the present value. Convert it into present value. Right. Okay. First, we need to understand these are what inflows. Hello, people. Everybody has agreed that I have calculated the tax savings by doing 50% of this amount. Sure. Whatever I write in P&L, no. Suppose 100 rupees I write in P&L as an expenditure. 50 rupees tax is saved. Net expenditure will be 50 rupees only. What you remember is probably interest into 1 minus t. That helps us to calculate net expenditure. I want tax savings. So the expenditure into tax rate is the tax savings. Okay. Right now the rate is 50%. By mistake you do 1 minus the amount will come same. But when the tax rate is 30%, what I need to understand, 100 rupees I spent, 30 rupees tax is saved. When tax rate is 40%, 100 rupees I spent, 40 rupees tax is saved. Okay, so tax savings you want, what you will have to do, expenditure into tax rate. Okay, yeah. So yeah, we will calculate the present value. Present value of tax savings is 65.536 into what is the present value factor of the fifth year? 0.57. So 65.536 into 37.3555. Okay, fine. Yeah. Now let's do some numbering, guys. Let's do some numbering. See, this is already numbered one. This inflows are already number two. It's also an inflow. So can I say now this is PVCI? So let it number out 3. So how we will write our MPV? We will say PVCI minus PVCO is equal to, guys. Now see, this 4, I will highlight that. This 401, bad idea, no? Red with red highlighting. No color sense. Yeah. 401.2721. Okay. 401.2721 plus this one, sorry, this one 37.3555 minus 400, and in bracket you can write 2 plus 3 minus 1, right? 401.2721 is our inflow. 37.3555 is also our inflow minus 400. So it gave me 38.6276. Yes. Now, so what we will say, since our company's name is there, no, it is not there. You have to advise the management. Okay. So what we will advise? Conclusion. The company should select the project since NPV is positive, right? Hello, friends. You understand what is WDV on date of sale? How to calculate? Is it the first time we are learning, or like you must have done no depreciation accounting? So what to do? Start from the cost of the asset, go on subtracting depreciation till the date of sale. That is called as what? WDV, right? You're doing it for the first time? No, done it number of times in fact. Okay, let's go ahead then. Since class 11, seriously, Lakshan, doing this calculation of WDV since class 11. I think so, yes. Even I had the same thing in class 11. Might be I'm little old and outdated. So I told you now, this is a very big problem. Still, people are not okay with 131.07. I wish I could throw some missiles on those people and destroy them permanently. Hello, guys. Chalo, we will teach them how to calculate. Why read? Susarita, why first time? Science student. Okay, that is fine. Then you are excluded. No missiles on you. Okay, turned back. Others were asking me 131.07 to how it came. Missiles are dropping out. You are away. They are left. Seriously, like uh, it happened in the other batch also. Like I was pretty sure that nobody will ask me how. I was so sure. Like it's like asking financial management spelling. Like why is it so? And I had to tell like it's like this only since childhood. Okay, still I have to consider now, however foolish it is. Arey, Roshni, dear, if you know, then why are you typing it? What is the point you write all over here? Okay, let's talk about it. Arey, don't send me in message boxes. These people will not understand. What is the cost of the set? 400. Okay, then you know what you have to do. You have to go on charging depreciation every year. Do you know that? Correct. Then charge depreciation minus 20% will come to 80. That's what you have calculated. So how much is left? 320. This is called WDV as on opening of year 2. This is year 1. Then again you charge depreciation less 20% depreciation of this. So we calculated those figures, no? Then they're of no use if you don't know this. Minus 64. So how much is left? 256. This is called WDV, opening WDV for year 3. Less 20% depreciation. And guys, don't sleep, Ray. Into 20%, 51.2. Okay. Then how much is left? 204.8. This is called opening WDV of year 4. Right, friends? Then again you will charge 20% depreciation for year 4. And that will be how much? Into 20%. 40.96. Then how much is left? 163.84. This is what opening WDV of year 5. Then you will charge depreciation 20% for Year 5 into 20%, 32.768. Then you will subtract this. This will be your opening WDV of year 6 that way. But then we don't call it year 6. We say, okay, fine. This will become my closing WDV of year 5, the day on which I sell it. So how much is left? 131.072 is left. People, if you're not from science, like Susarita, and if you don't know this, I can courier even some water at your home where you can jump and prefer to die. What people are laughing? WDV method of depreciation not done. Done, no people. Seriously, Ray, we are doing this from childhood. Okay, anyways, those who don't know, they have all the right to know the things. So make sure your syllabus for 11th and 12th and competition must be different. For some people, it was not there. No worry. People are not doing TP with me. They are doing TP with themselves. Rishabh is telling me, sir, they know it. People are doing TP with you. No, no, no. They are TP doing it with themselves. Chalo, people will go ahead. Once don't sleep, pray. What is this one? Oh my God. Come on, you're done. Anybody wants this, take a photograph. I'll also smile in the photograph. Come to the next question. Let's come to question number 10. Now what? Thank you, Nikhil, for adding information. Nikhil is saying we can just do it by getting multiplying 80%. Okay, thank you. If we were to write the depreciation amount in the solution, here we were to write the depreciation amount. How would I get it just by doing 20%? I had to write these depreciations also. How do I do it just by doing 80%? Nikhil, sir, do 80% and then subtract. And then the better is to do 20%. But WD, so one. Sorry, no argument. You are right. Okay. Thank you. Let's come to the next question. Question number 10. We read this question. Let's start, guys. A hospital is considering to purchase a diagnostic machine costing 80,000 people. You understand hospital? Did I tell you get educated? I'm just asking. You understand hospital? Yes. You understand diagnostic machine? No. Any machine which is used for diagnosis is a diagnostic machine. Okay, X-ray machine have you heard of? X-ray machine you all have heard of, no? What it is used for? Making drawings, no? Painting, drawing. No, Sam. It is used for doing X-ray. How that X-ray helps you? Take a photo. How that X-ray helps you to do diagnosis, no? Right, not to find out whether you are suffering from some disease or whether you are all okay, right? So any such machine is called as what? A diagnostic machine, right? Now, because of this corona pandemic, what has happened? Many people have that SpO2 machine at home. Oxygen level it checks, no? Right, oximeter, yeah, oximeter. Thank you, Rakshita, for giving me the word. Right? Then some people have got blood pressure monitoring machine at home, right? And some people also have the sugar monitoring machine at home. What is all this is? These are all diagnostic machines. Do we keep CT scan, digital X-ray machines at home? No, sir. These are not our hospital, it's our home. So basic things we have. So now you understand diagnostic machine. Sure. Any machine used for diagnosis is a diagnostic machine. Yes. Okay. Fine. Huge capex. Correct. Correct. Anyone from medical field at your home, right? Lecture? You're replying me huge capex. Please write down, guys. I'm very confident. All commerce now. I'm very confident that you'll forget it after a few months. The way some of you forget what is WDV, how to calculate closing WDV on date of sale. So please write. Yeah, not few months. Within few weeks. Only what few weeks you are talking to me, sure. Next 5 minutes, diagnostic million. What is that? Who told you? They never came in the syllabus. The projected life of the machine is what? 8 years. And it has a salvage value of 6,000 at the end of 8 years. Obviously, life of the machine is 8 years. Right? Salvage will be at the end of 8 years. Only. Annual operating cost of the machine is 7,500. Guys, remember our income statement, railway station platform. Right? So here, what we do, we are going there. Long time, sir. More than 15 minutes. Sir. We are not saying forgotten, sir. So what we do from sales, we first subtract variable cost and we then subtract fixed cost. I think they have clubbed it and given us. Right? Go to the question again. Check what they have told us over here. This is annual operating cost. So have they given the bifurcation? No. So can I say it is variable cost plus fixed cost? Is that okay, guys? Fine. No bifurcation is also okay. No? Yeah. Presently, the hospital is outsourcing the diagnostic work. Hey, you understand this? Hospital is doing what? Outsourcing the diagnostic work and earning commission income of 12,000 per annum. Yeah, very important to understand practicality. See, like in whichever area you stay, okay, we all don't stay in the same geographic location. But I know. We have something like small hospitals and big hospitals. Yes or no? We all see that. We all see that. There are some small hospitals. How these small hospitals happen in some building, they will purchase 2, 3 flats, convert it into a sort of a hospital. Each room becomes a bed, beds having 2, 3 beds. Small hospital. Somewhere in the corner, they may have an X-ray machine. But something like CT scan is asked, MRI is asked. What do? They write a prescription and give it to you and tell you that you go and get it done from diagnostic centers. Right? What is this? Outsourcing. Correct? And then from the hospital there are 2 diagnostic centers, one here, one there. But they always give you prescribed on the letterhead of one particular diagnostic center only. Why? That is written over there. Dang, dang, dang. Understood. Commerce, so at least to understand. Science we don't understand. Okay, X-ray machine, CT scan, etc. We will not understand. But commerce behind the science, so you understand. Right? The hospital is sent to a particular diagnostic center only. Why? They get some commission from there for sending patient, a referral, right? A small thank you given in money form. Fine. So what is happening right now, guys? Right now, the hospital is having that diagnostic machine with them. No. What they are doing, they are sending their patients outside. Right? Now, what is their plan? Let's purchase the diagnostic machine only. Simple. Let's purchase what? A diagnostic machine only. Yeah. Okay, friends, just make an addition over here. Net of taxes. Then tax rate is not given. Please write over here. Tax rate being 30%. This addition to your question. Tax rate being how much? 30%. Okay. Required whether it would be profitable for the hospital to purchase the machine. Give your recommendations under what? Net present value method and profitability index. And then I always tell you this, present value factors given in the question, then don't change it. Okay. See guys, what I have to make sure, how I will solve this. I'll have to find out cash inflows of each year. What I have to make sure, the cash inflows are higher than outflows. Right? And see, listen, the moment I decide that I will have my own diagnostic machine, will I send my patients outside? No, I will not send. Correct. Okay. So if I don't send my patient outside, will I earn that 12,000? No. So whatever are my annual inflows, no, I have to consider this loss of income also. The moment I bring diagnostic machine and I stop sending the patients outside, I stop outsourcing it, what is going to happen? I'm going to lose that 12,000. So I have to consider this loss of income also, right? How we will do that? We'll present it. We'll present it. Don't worry. Let's see. Let's see our solution. Okay, so let's talk about question number 10. See, let me give you some brief. Okay, see, first we are writing the PVC. Okay, then calculation of what cash inflows. Now, see here, friends, what is the difference between this question and this question? You understand? Here it was all different. Here, what it is told in the question that the annual sale is going to be 40,000. Correct? Okay, so operating cost, as we discussed, it will be what? Fixed cost plus variable cost, both taken up together. So this is my station number 1. Even if you don't write this in the exam is okay. Obviously, you don't have to write in the exam. Now, station number 1. Station number 2 and 3 is combined. Got it? Got it? Variable cost, fixed cost combined. Okay, fine. Then I'm back to station number 4. Cash flow before tax, which we also call as what? Net profit before depreciation and tax. Then onwards, you can continue solving, right? So this would become 32,500. Okay, friends, how do we calculate depreciation? We need to be very careful. What is told? What is the cost of the asset? The cost of the asset is 80,000. Okay, minus there is some salvage will be expected, right, guys? 6,000 divided by what is the life of the asset? 8 years. Okay, so 80,000 minus 6,000 divided by 8 years gives me 9250. So that you find minus 9250 is 23,250. Yeah. Yes, Sunny. Into 30%. Sorry. 6975 minus equal to 16,000 275. So I'll add back depreciation plus how much? 9250. So it is 25,525. Yes, correct. 25,525. Yes, Umesh. Yes, Sanya, right. Okay. Now what? See, this is my ordinary cash flow after tax, right? But what am I doing? Less loss of commission income. Okay. It is given in the question that it is what? Net of taxes. Okay. 12,000 rupees I'm going to miss. In the process, I'm going to earn 25,525. Do you understand this point, guys? Have you all understood this point? 25,525 I'll earn, no, but in front of that, in exchange of that 12,000, I will lose. So effectively, what I will be earning? I'll be earning the difference of this minus 12,000. That is 13,525. Correct? This, hello people, you all understand this loss of income? Sure, now logically I see 25,525 I will earn. But in what is the cost of earning that? At the moment I bring the diagnostic machine, will that diagnostic center pay me this 12,000 commission? No. So 13,525 I will earn, sorry, 25,525 I will earn and 12,000 I will lose. So effectively what I will earn is 13,520. One more minute guys, I'm not yet done. Listen to me first. Why did I subtract the loss of commission over here? Why did not I take it before tax? Very clearly written, commission income is what? Net of taxes. Commission income is what? After tax commission income, right? Net of taxes. So then what we have to do? We should compare it with the after tax income, no? Agree, all of you guys, you agree? You understood what I said? See, if this commission income was given before tax income, then what I would have done? I would have subtracted over here, less depreciation, less, see here. I would have written over here, less loss of commission income. Then automatically tax effect would have been come. But they have very clearly given that it is what? Net of taxes. That's why whatever is my cash flow after tax, in that I have considered. Okay, so in this point, we are absolutely pretty clear with that, right? Yeah. Okay. Yeah, this is only for us, guys. Some sort of GAN distribution, knowledge distribution. Yeah. I hope you are all done to hear. Are you still writing this part? Okay. I'm there. I'm not going anywhere. Where I will go? Logged on outside. And it's already 11 o'clock. 11 o'clock, our all markets close. Even the essentials are sort of off. Only medical. I don't need any medicine. So here I will. I have to sit in front of. Yeah, people, you are done. Yeah, how much people are writing? Then I have to tell people write once only, revision at home. Since people are taking final answer, I'll be there. You can understand from you people. People are seriously writing. Done, na Shruti? Wait. Let everybody complete. I can still see those faces sincerely copying. Pooja Venkat still writing. Afra done. Afra shifted. No more evening batches. But in the morning nowadays. No problem. Listen to the Babaji's pravachan once in a day, some or the other time, as per your convenience. Uh, People, shall we go ahead? Done or not yet? Done. No? Done. Done. You can see those faces saying that. Okay. Bunch, where are we going, man? Where are we going? Then I suppose everybody is done now. I hope you took some time to write all this, right? Guys, this only for us note. Did you understand what is written? If we install our own machine for diagnosis, then we won't send patients for diagnostic reports outside. So we will not in this commission from diagnostic labs. This is making it further crystal clear, right? Why that 12,000 is subtracted. Okay. So time to go ahead then. Okay. So let's calculate. We are done with annual cash inflows now. So calculate the PVCF. Annual cash inflow, that is 13,525 into present value of KO. Guys, KO is how much? KO is not given specifically, but we are given present value factors of 10%. So we will, let's say 10% of 8 years. Guys, I strongly recommend whenever question gives you the rates, use those only. Right? You are okay with this PVAF of 8 years? Because annual cash inflow is same, no? Right? So we can take a total of the numbers directly. Okay, just do one thing. Don't calculate on your calci. Rather do what? Take a total of the same numbers. Okay. So I'm taking the total of the same numbers. 0.909 plus 0.826. I mean to say that don't deviate from these values. 683, 621, 56, 513 plus 0.266. What is your total? Same guys. Someshwar, total wrong Ray. Anna, for 8 years you do man. Yeah, you changed. You are changed, it seems. He's saying, I changed, sir. Okay, fine. I know that you are changed a person now. Okay, so this into 5.334. That's it. See, all this is okay as long as it's not exam. Huh? I hope you get my point. So this is 72142.35. And salvage will also come now, guys, in inflows. Don't forget that. How much is our salvage? 6,000. So 6,000 into the present value factor of 80 or 0.467. 6,000 into 0.467 into. So it's 2802. 74,944.35. What's it, guys? Huh? So calculate NPV now. ABCI is how much? 74,944.35 minus what we noted the PVC. What is the cost? 80,000. Negative 5055.65. Oops. What to do? Shall we go for this machine? No, sir. No point going for this machine, sir. So, see, hospital is asking your advice. Let's write conclusion. It is not advisable to purchase the diagnostic machine since what NPV is negative, right? What hospital should do? Hospital should continue outsourcing the diagnostic work. Correct, no? So, guys, it's not all about making commission money. They understand that diagnostic houses specialize in this. You understand what I said? Diagnostic houses specialize in this. They can offer better rate even to the patients. Why? Because they do the testing on bulk. Whatever it is, however big the hospital might be. Hospital will never have that many patients. Wherein diagnostic centers will always have a flow of patients coming from all hospitals. Yeah, so that same thing benefits of operating on large scale. Right? So that is the current scenario, guys. That is the current era where everybody is going for what? Specialization. Okay. Yeah. Let's calculate profitability index as well. I think I'm not left with much of space. I'll just write over here. which is what? PVCI upon PVCO. PVCI 74,944.35 upon 80,000. 74,944.35 divided by. So is it 0.94 we can say? So again we will write student diagnostic machine since what? Since profitability index is less than 1. So both methods obviously show you the give you the same conclusion. So make sure you don't convert it into the percentage, right? It's an index. Okay. Indexes are never in the terms of indices are never in the terms of what? Percentage. Yeah. Now the most favorite part of this lecture. Break, correct. 3 minutes break and then resume back. Okay. I know people are there. Okay, people, let's go ahead. How to calculate present value unity factor? Everybody understands. Total of the factors, no? I've taught you or not? Tell me. Did you people read the theory someday? I think in question number 2, where we learnt NPV method, we have done some DW. You know what is DW? Purposely. DW, donkey work. Right? It was cash inflow was constant. 50,000, 50,000, 50,000, 50,000. Look into the solution. Those who are not remembering, how to get that 5.334. Those who have messaged me but not getting 5.334. So tell the names. No, I won't. It happens. Sometimes people forget, guys. So what we have discussed, what is the simple logic? Is it something new formula, or is it's a sheer understanding of board mass? It's a sheer understanding of board mass. Look into the solution of question number 2. 50,000 into present value of first year, 50,000 into present value factor of second year, 50,000 into present value of factor of third year, and so on. So what is the simple idea? Remove 50,000 out of the bracket. Inside, what will be remaining? Sum of all the factors. You don't have. You have not attended this lecture, dear. I'm not talking to general public. I'm talking to the replies that I'm getting. Whoever is having an issue. I attended. Yeah. Attended. Don't do that. Wait. Don't start popping out of your seats. But you have not attended this part. Could you please reply? Achha, this is your first lecture. No worries. That's what. No, I should know case specific now. Then I can deal better with you people. Anyways, no, whenever I shout, I don't take the names. You are excluded because this is your first lecture. But otherwise, also when I shout, I don't take the names. I don't like public defamation. There are exceptions, yes. Some people I shout first taking their names because they do the default every single time. Who's raising the hand? Who's that? See here, I have discussed while talking about present value factor. And this was a question number 2. See, I have written over here. Okay. Let's see, take the cash flows after tax of every year, multiplied by what? Present value factor. But the thing is that it is same every time, no? This cash flow is same every time. So what we can do, take this 50,000 out common. It's like writing like what? 50,000 into 0.893 plus 50,000 into 0.797 plus 50,000 into 0.712 and so on. So what we are doing, taking the 50,000 common, so only the present value factors are added. See, I have written alternative way of calculating PVCI when annual CPAT is constant. PVCI is equal to what? Annual CPAT into present value unity factor of KO for 5 years. Simple as that. That is the logic that we have applied. Okay, so I propose to go ahead and people, please, if you have missed earlier lecture or whatever, please first go through the recorded lectures as early as possible. Okay. Yeah, and for that, I'm not a correct person to ask. That office guys will tell you what is the procedure. Come to question number 11. Meanwhile, everyone out there, everyone out there. Come to question number 11. Let's read it. The management of PV method is considering selecting a machine out of two mutually exclusive machines. Hello, people. You've done some probability in your life. Now, don't tell me I am new to this class. Probability I don't teach, and you learned in earlier standards. So, Sarita, don't tell me, sir, I am from science, sir. You still have done probability, right? Huh. Okay. So, two mutually exclusive projects means what? Either of them. Okay, either one or two, whichever. Okay. So, what is told? Company's cost of capital is 12%. So, please mark this as KO. Corporate tax rate is 30%. Nice to know. Details are given like this. Cost of machine, guys, write it PVCO. Expected life, not yours, machines. Okay, 5 and 6 years. Hey, hello. Annual income before tax and depreciation. Come on. Send me in chat box, huh? Station number. Send me in the chat box, then either I can see your faces or I can see the chat box. I see the chat box. My God, how can you all give so correct answer? Somebody make some wrong answer, please. Why everybody is writing the correct answer? Somebody has to be there now. No? Ah, 5. Very good. Thank you, Lakshmi, for making me feel good. Huh? Thank you. Station number is marked up now. Yeah, good. Very good. Array, that is important. You understand, guys. If you, why I ask this again and again, you understand my pain. That if you interpret this as cash flow after tax, the whole of the efforts that you are taking are gone to dogs, maybe some other animal, depending upon the availability. But it's a waste of efforts if you don't identify this number correctly. Okay, so please do that for me. Yes, you all are right. This is, we can say, cash flow before tax, also called as what? Net profit before depreciation and tax. Wow, Rishabh, very nice man. What an amazing answer. So much time in the life. Huh? Depreciation to be charged on straight line basis. You are required to calculate discounted payback period, net present value, and IRR. Okay. Now it comes not just to calculate, it also comes to giving the advice to the management, guys. When remember this is 5 years and this is 6 years. When it comes to giving the advice and it comes to NPV, we will have to do it what? We will have to annualize it. Simple. The rest all are okay. This is the payback period and this is the IRR, rate of return. So there is nothing like annualization. But here we have to do annualize. And then for helping out, what is the KO? KO is 12%. Na? Fine. Na? So they have given you some rates 13, 14, 15, 16. Okay. So let's start with this. Okay. So I will show you what is to be done. See. We'll start from station number 4, right? Cash flow before tax or net profit before depreciation and tax. Subtract what? Depreciation per annum. So you get net profit after tax, less tax, net profit after tax. And then add back depreciation to get what? Cash flow after tax or cash inflows. Correct? So let's first keep this part ready. I've just demonstration. For one I have done. Rest you have to do. We'll solve together. Yes. Let's start. So first machine 345 is the cash flow before tax, that is net profit before depreciation and tax. 345 minus 2 lakh 145 into 30%, 43,000 fund 10159. Add back depreciation 2 lakh. So 301,500. Okay. Yes. Come to this side. Huh? I mean to say, just keep this ready. Then obviously, then you will solve machine wise. But at least this working, so you can keep ready. No? Just 455. I've written up for second machine also. You can see that 15 lakh minus nil upon 6. 2 lakh 50. Depreciation will be 2 lakh 50,000. So 205. 61,500 minus equal to gives me 143,500. Add back depreciation 250. 393,500. Yes, yes. 393,500. Okay. So you have to calculate what discounted payback period. Then you have to calculate net present value on IRR. Okay. Acha, people, one minute. Huh? You know what common confusion comes in the mind? Listen, listen. Sir, annual CFAT is the constant, sir. Then why are we preparing like this? Guys, tell me. We are calculating what? Payback period or discounted payback period? Discounted payback period, right? Huh? Discounted payback period is not done on CFAT, it is done on PVCI. I agree. Annual CFAT might be constant 301,500 everywhere. Correct? No? But when I will multiply it by the present value factors, will the amount remain same or it will change? It will change. Correct? So I will have to do this calculation. I have to do this calculation. You understand? Because half the people think like, can I constant, sir? Constant, divide. What divide? We're not doing payback period. We are doing discounted payback period, which is done on the basis of PVCIs. Okay. Sure, fine. Let's start this. So present value factors of 12%. Copy from the question. Right? Copy whatever is there given in the question. Huh? So it is 0.893. 0.797. 0.712. 0.636 and 0.567. Now what do I do with the sixth one? Eat it up. It's for 5 years, so we'll do it for 5 years only now. The life of the asset is 5 years. 301,500 into 0.893 plus. So PVC is 269,239. 269,239.5. Okay, so cumulative PVC, first year it is same, right? 269,239.5. Okay. Then 301,500 into 0.797 plus 240,295.5. Memory recover is 509,535. Let's do next year. 301,500 into 0.712 m plus 214,668. Again, I do memory recover, so I get a total 7,24,000 203. Again, I do the next calculation. 301,500 into 0.636 m plus. I get this answer as 191. 191,754. Memory recall gives me 915,957. 301,500 into 0.567 m plus 170,950.5. Memory recover gives me 1086,907.5. Okay. And then what is the initial investment? Have you written it? No. Okay, you can take it from the book. No. 10 lakh. So what do you say, guys? What do you say, guys? It lies between over here and here, no? Therefore, discounted payback period is between what? Year 4 and 5. Correct? So we will write discounted payback period. We'll say yes, 4 plus to be recovered in 5th year. Correct? Whatever is the balance to be recovered in 5th year divided by what? Hello guys, PVCI of 5th year. It's a discounted payback period method. PVCI of 5th year. That is equal to 4 plus. Tell me how much we have done till 4th year end? 915,957. No? Our cost is 10 lakh. 10 lakh minus 915,957. So we are still to recover 84,043 rupees. How did I get it? 10 lakhs minus 915,957 divided by PVC of 5th year. The PVC of 5th year 170,950.5. Divide this by 170,950.5. I got it 0.491. So 0.49. So we can say 4.49 years is the time taken for the recovery of the cost. Okay. Once I'm done with this, then I can easily calculate NPV. You remember yesterday also it had happened. Yesterday I mean to say last lecture. That NPV is what? PVCI minus PVCO. And PVCI we already know, guys. We have done the total over here. Correct? 10 lakh 86,907.5. PVCO is 10 lakh cost of the asset. 86,907.5. This comes very fast. This comes very fast. Okay. Now we know what that NPV is 86,907.5. Means we discounted at 12%. Correct, friends? We discounted at 12%. Still it is higher. Still it is positive. Means our internal rate of return would be lower than 12% or higher than 12%. Higher than 12%. So I'll discount now by the factors after 12%. Okay, see. I'll show you the question. See here. So after 12, there was 13, 14, 15, 16. So higher than 12% is this now. So what we will start with? Shall we immediately start with 12, 13? No, what we should do? Either 14 or 15. Why? See, there are 4 values, right? If you just start with 13 and you get positive answer, then you have to go with 14. Still you get positive answer, go with 15. Suppose I get 15 only and I get positive answer, then I will go with 16. But I do 15 and I get negative answer, then I know that I have to go with 14. It saves our time, na? Did you understand what I said? Huh? So I'm trying with 15. Frankly speaking, I'm trying with 15. Okay. Hello. Let's start. Can I take some shortcut over here? Annual CPAT is constant, no? So I can say PVCI at 15% will be equal to annual CPAT into present value annuity factor of 15% for how many years, guys? 5 years. And don't forget the life of the asset is how many years? 5 years. Okay. So annual CPAT we got now 301,500 into 15% first 5 years total. Total 0.870, 0.756, 0.658, 0.572, 0.497. Is it coming 3.353? Guys, if you could confirm. A video confirmation is also okay. Same now. 5 years you take, guys. Just don't go on adding everything. The factors given there are like 6 years. Don't do that. Okay, 5 years. Yeah. Okay. So I got it. 1010929. Oh, cost is how much? 10 lakh. Means our returns are higher than 15%. Now I discount by 16. Right now? Huh? Okay. So let's go with 16, guys. Let's go with 16. PVCI at 16%. Annual CPAT into present value annuity factor at of whatever 15% for sorry, not 15%, 16%. For 5 years. So 301,500 into now 16% first 5 years, only 0.852, sorry, 862 plus 0.74, 743 plus 0.641 plus 0.552 plus 0.476, 3.274. Oh, yes, I got your answers. Rakshita, Mohit, Pratiksha, Hariharan, thank you guys. Now this into 30151. Finally gone below 987,111. Correct? Just analyze. Okay, people, final no between 15 and 16, right? Okay. So the way we normally present, we will write. Okay. How we present, you remember, I hope. We write present value factor at 15%. PVCI come to 1010929.5. Present value factor is 16%, then it is coming to 987,111. And then we write like this. Okay, this is plus 1%. It is minus 23,818.5. Correct, friends? Now 23,818.5. Yes, one. Okay. So So now we'll write, but PVCO is 10 lakh, correct? Therefore, if you are done now, guys, don't wait for me. Go for the next machine. Machine 2 also you have to do, no? Don't sit idle. Yeah. But therefore, IRR is between 15 and 16%. So we write like this. Therefore, IRR is equal to 15 plus present value factor and PVCI changes we record. In present value factor, 1% change. PVCI is down by 23,818.5. We don't have to reach so far. We just have to reach till 10 lakh. So how we will get that difference from 10 lakh, 10,000, 9 to 9.5? I will reach till 10 lakh. So how much I have to decrease it? I have to decrease it by 10,000, 9 to 9.5. Okay. Therefore, IRR is equal to 15 plus minus minus sign will go 10,000, 9 to 9.5 divided by 23,818.5. 10,000 into 9.5 divided by 23,818.5. I got you 0.458. So 15.458 is 46. So IRR comes to 15.46. 15.46, guys. 15.46. Vansh, please check your answer. Vansh Rushi, check your answer, hey boy. Got it now? Same answer you got it now? Okay, check it. Okay, I saw you nodding your head. Tick. What you people are relaxing? No, no. We have one more machine. Come on, calculate. Don't sit idle. So all we did for machine 1. Now let's do it for machine 2. What is the annual cash flow? 393,500. Okay. Discounted back period. Year 1, 2, 3, 4, 5, 6. Hello, people. Life is 6 years, right? Machine 2 life is 6 years, no? Don't forget that. Cash flow after tax. 393,500 we calculated, no? 93,500. Present value factor at 12%, right? KO is 12%. 0.893, 0.797, 712, 0.636, 0.567, and 0.507. Multiply this, so we get PVCI, and then the next column we write is cumulative PVCI. And I we can use M plus as a function and complete this. 393,500 into 0.893 plus 351,395.5, and the first year will be same, no? 351,395.5, 393,500 into 0.797 M plus 313,619.5 Memory recover gives me 665015. Then 393500 into 0.712 and plus this is 280. People done or what? Started giving answers. Oh my god, Yash is done with everything. Very fast man, very fast. 280172. Memory recover gives me 945187. Okay. 393,500 into 0.636250,266. Memory recover gives me 1195453. Again 393,500 into 0.567. 22311. It went wrong it seems. Point 223 114.5. This total is 14, 18, 5, 6, 7.5. Oh my gosh, people are getting it done. Smarties. Okay, then 393, 500 into 0.507, 199, 504.5, and the last answer is 16, 18, 07. And then what is our cost? The cost of the asset is 15 lakhs. So we know now again the same thing, guys. Discounted PBP, payback period, is between what? Between 5th and 6th year. Correct, friends? Right? Yeah. So therefore, you're right. Therefore, discounted payback period is equal to 5 plus to be recovered in what? 5th year divided by PVCI of divided to be recorded in 6th year. So divided by what? PVCI of 6th year. That is equal to 5 plus. See, till the end of 5th. Okay. Till the end of 5th year, 14. Okay, our cost is 15 lakh, right? Minus how much we have recovered? 14, 18, 567.5 we have already recovered. So how much more we are left to recover? 81, 432.5 we are left to recover. And the PVCI of the 6th year is 199,504.5. So divided by 199,504.5. So we got it 5.408. So let's make it 418. Okay, friends. Then NPV would be very fast. I'm very sure NPV you must have done. NPV is what? PVCI minus PVCO. PVCI, guys, total is already there, right? 16, 18, 072 minus PVCO 15 lakh. So 1 lakh 18,072. NPV is also done. Okay, go for IRR. And then I've already told you we will do with same logic, 15% logic we will do. Okay, IRR is also done. Super. So present value cash inflows PVCI at 15%. I will get it annual CPAT multiplied by present value annuity factor of 15%. But of how many years, guys? 6 years, huh? 6 years. So add up everything. Earlier we had calculated, huh? 5 years we calculated. 5 years was how much? 3.5, 3.353. Plus the last year I will add 0.432, 3.785. So 393, 500. My goodness, people are giving me so answers so fast. Into 3.785. Sorry, Mohit, what IRR you what PVC? I think you typed slightly. There is some error sort of it seems. I got it 1489 397.5. Oh, you understood, people? What am I saying? We divide now. See, now we got a direction. Now you all tell me. We will divide. Now we will take rate higher than 15% or lower than 15%. Lower. Now everybody got this idea. As such, we have to do trial error. So let's do it more sensibly. Lower, yes. Yes, let's let do. So PVCI now at 14% we will do. That is annual CPAT into present value annuity factor of 14% of how many years? 6 years. 393, 500 into 14%. 0.877 plus 0.769 plus 0.675 plus 0.592 519 3.888 3.888. Yes, fine. Yes. So 3.888 into this 393,500. So now we got it. Now we got it 1529,928. You understand? And normally we calculate this. So no, this is higher. Let's do by this higher rating. Higher rate we have already done. So we know it is between 14 and 15. So let's write as usual. Present value factor 14%, 15%. So if it is 14%, the PVCI is on a higher side. 1529,928. But if I do by 15%, it is already below 15 lakh. 1489,397.5. So you know it's between these two. Right? This is plus 1%. 1489,397.5. 40530.5 minus of 40530.5. So we'll say but PVCO is 15 lakh. Therefore, IRR is between 14% and 15%. So we'll calculate. IRR is equal to 14 plus 1% PVF. PVCI is down by 40,530.5. But I don't have to go so much down. I have to reach to 15 lakh. So I will say, okay, I will reduce it by 29,928. Correct? So IRR is going to be 14 plus 20, minus signs will go, right? 29,928 divided by 40,530.5. So 29,928 divided by 40,530.5. It comes to 738, na? So see what point 14.738 is 74%. Yes, friends, we all have got it correct. Perfect answers. I just now started seeing your answers after I come. Rahul, I think this must be typing error. You have typed 14.26, 14.74, no? It's there on the screen. Just now we have calculated. Okay, fine. In your book, the answer should be correct. Okay, in your book, the answer should be correct. This question is still there. People, you've been little slow today. Other batch have completed some other extra questions also. Anyways, we will manage it, don't worry. Make a quick decision table. I'm writing over here only. You write at an appropriate place. Decision table. Listen, there are machine 1, machine 2, right? And then decision. Okay, so how we will write? Listen to me first. Write NPV. No problem. Write the NPVs. How much you got NPV? 86907.5. 86907.5. Wait, don't write the next part. Write annualized NPV. Okay, that is NPV upon PVAF. Please do that. Now, NPV is how much? 86,907.5. Right, friends? Okay. Take the total of all the discounting factors of KO. 0.893 plus 0.797 plus 0.712 plus 0.636 plus 0.567. 3.0605. Yeah, so 86907.5 divided by 3.605. We are getting it 24107.4. 24107.5 we can say. 489. So ultimately it will become 5. Right? Okay. Then write the other things that you calculated. Discounted payback period. How much is that? 4.49. And then write what? IRR. IRR is there itself, 15.46%. Okay, friends? Yeah. Then write for machine 2. Discounted payback period, I would see 5.41 years. NPV we calculated, no? 118072. Listen, right over here. 118072. But then you know what you have to do. You have to divide it by PVF, not 3.605. Guys, 3.605 is only for 5 years. We want it for 6 years. So 3.605. In that, add the 6 years factor also, no? 0.507. It came to 4.112. Correct? So divide 118072 by 4.112. Check your answer, guys. I'm getting it 28714. What say, people? Have you got these answers? Right? Okay. Okay. And then write IRR as well. IRR is how much? 14 point something, no? 14.7. 14.7. Okay. Now take your decisions. I think this is machine 2. Higher NPV is over here. Machine 2. Discounted payback period, guys. You can go with what? Lower period, right? So machine 1. And if it's to IRR, then what we do? Higher one we select. Machine 1. So what is our final conclusion? You know, we have written like this earlier also. As per annualized NPV, select machine 2. Right? If you are following NPV method, select machine 2. As per what? As per discounted payback period and IRR. What we would say? Select machine 1. Okay. Guys, tell me, are we making the discounted? Why we are finding annualized NPV? Why people always forget few things? Hello? Are today morning also I make you recollect what if life of the two projects is same, then what is comparable, NPV or annualized NPV? Annualized NPV na? What man? What? Shat. Shat. Okay, let's go ahead. All screenshots at the end, guys. We are a little lagging behind. Today. Done with the decision table. Okay, we'll come to the next concept. You will be taking photo of that. You will not be writing that right now. As usual, guys, those who do attend the lecture for the first time, whenever theory comes, and sometimes I ask students to take a photograph of the theory and write it later on, leave some space. Sometimes I make the right theory. Depends upon matter. Like for this chapter, we have always written the theory. This is I think this is the first screenshot you will be taking for this chapter, right? Say yes, no, we do. At least be that way. Okay. So let's come to the concept, guys. Let's come to the concept. Okay. See, it's going to be one side, but first you pay attention. Later on, take a screenshot. First, first pay attention. When a company plans to replace the existing method of production by some new method, for example, what? Changing from manual mode to automation mode. Okay, what happens? It always leads to some additional costs and some additional savings. Correct? Sales remain unaffected. What you have to ensure? The additional savings over and above the additional cost becomes your net cash inflow. Right? See, and this cash inflow should cover the cost of new machine when the project is feasible. Okay, means what? Suppose I'm already doing some work using labor, and I realize that the process is very slow, time taking. So what I say, no, let me bring machine. Now by bringing machine, no, sales is not changed. Sales remain that only. So what I have to ensure? I replace the labor by machine, no, it will make some savings for me. If those savings cover up my cost of the asset, then I'll do the project, otherwise I'll not do it. Okay, I'll tell you one practical real life example which will convince you very fast. See, let's take this example. Now, a cab driver owns a petrol driven car. Fine. And his running is around 1 lakh kilometers. Petrol cost is coming to 6 rupees a kilometer and maintenance is 30,000. Understand? This is a imaginary scenario. So when he will run his car, he will end up spending 6 lakh rupees on petrol and 30,000 on annual maintenance. So his outflow would be how much? 6 lakh 30,000. Right? Now everybody will try to cut on their cost, and he will come to know, yeah, in the market there is an option available, something called a CNG, compressed natural gas. Right? In some region it is available, in some region it is not available. But assume wherever he is operating, there compressed natural gas is available. Let's assume that. Okay. So then obviously he goes for that. So he makes his calculation. Okay, fine. That if I go with existing setup, this is a position. Now he's planning to install a CNG kit. Let's say CNG cost only rupees 3 per kilometer. Now what will happen, guys? His running will remain 1 lakh kilometer only, or will it change? See, when I book Ola Uber, when I'm out station, when I book Ola Uber, do I call the driver and ask him, hello, do you CNG, na? Huh? Good, very good fuel, huh? Environment friendly, huh? And it will save your money. If you have CNG, then only you come to pick me up, else I will cancel it. I mean, let him put CNG, let him put petrol, diesel, I don't care even if he puts kerosene. His cab should run and it drop me at the destination on time. That's it. So this 1 lakh, but does this 1 lakh kilometer change, guys? Think from the customer point of view. Will this 1 lakh kilometer change? No, that will remain same only. But what will change for this fellow? Running cost will come down from 1 lakh to 3, from 6 lakh, it will come down to how much? 3 lakh. So savings. But now what is happening, maintenance is getting a little costlier. Why? The car maintenance is 30,000 plus he will install that CNG kit. Na? There is a CNG kit, there is a CNG tank to be installed. So its maintenance will add up. So earlier the maintenance was 30,000. Now the maintenance is becoming 50,000. So you'll spend something extra on that. Understood now, people? Okay. And see, CNG kit won't come for free. No. Government is not distributing CNG kits for free. That he has to pay. So he has to pay the cost of CNG kit 1 lakh. Still see, because of those petrol savings, 3 lakh running cost, 50,000 maintenance, 1 lakh additional cost, 4 lakh 50. Guys, still you compare these numbers, no? Still you compare these numbers. What do you see? Earlier you were spending 630. Now we'll be spending only 450. What's it, guys? Savings or no savings? Savings. Tell me, is it a feasible proposal for him? Yes or no? Yes. Sir, but we don't know his revenue. What the hell with his revenue? Revenues are assessed going to remain same. I told you now, as a customer, you are going to select only CNG car or what? Then no, sir, my relative has a diesel pump. I will select only diesel pump, diesel car. It doesn't matter, man. Sales is not going to change only where. So you know what? This guy is going to experience additional inflows of how much? This guy will enjoy the additional inflows of 1,80,000. Nothing. No increase in sales. No increase in sales. Still, he will enjoy what? Additional inflows of how much? 1,80,000. Right? And he said, okay, fine. Let me install the CNG kit. Did you understand the story, guys? Let me ask you people. Hello? Did you understand the story? Sure. Everyone out there? Okay. Thank you. Thank you. Thank you. Thank you so much. Thank you. Thank you. This is for Tanvi. Like everybody this. Tanvi is saying, I understood twice, sir. Okay. Good. I'm very happy people are still participating. This lecture will end in half an hour. And anyways, today we will not end in half an hour. We will extend. We have to keep all the batches at par. Today some extra inquiry has taken some extra time. No problem. Take till 1:15 a.m. na till night na yeah. Okay. Thank you. Take the photo shot, please. Photoshop is a new word. Screenshot and Photoshop. Or do whatever you like. You like photo, you take photo. You take screenshot, you take screenshot. Photoshop. Done. Come to question number 18, please. Come to question number 18. We have to deal with it very fast now. Let's see. A Limited is considering purchase of machine which will perform some operations which are at present performed by workers. Automation process, automation. Machines X and Y are alternatives. So following details are available. Cost of the machine, TVC, O. Life is 5 years and 6 years. Estimated cost of maintenance. Oh, guys, pay attention. If you ask afterwards, I'll throw you out of the class. Pay attention. So when I bring the machine, guys, I have to spend this extra money. So this is my cost. Cost of indirect material. You understand the indirect material? Hello? You understand indirect material? See, machine we bring now. So we have to apply some grease to them to clean them by a cotton gauze. Do we do same thing for our workers? Our workers are working for 8 hours. After that, we apply some grease coating to them that they should be lubricated well. All their joints should be lubricated. No. No indirect material for them. But here we will have to spend on indirect material. Okay. Savings in scrap. Hello, all my dear friends. Every person alive there. Are you alive or dead? Confirm. Alive. Good. Alive. No? Very good. Now tell me, savings in scrap. What do you understand by that? No crap. No crap. It's a scrap. Savings in scrap means what? Shh. No salvage value. Shut up and listen. Kindly shut up and listen. Yeah, it's a request. Salvage is not a salvage value. Dumbos. When a human person, when a human does a work, there's always some amount of wastage. Howsoever expert you might be in your work. Right now, it happens in hotel industry, it happens in every business. Okay, suppose a person is serving in hotel, serving since 20 years. One day at least he makes a mistake. The food falls, it spills over, food is wasted, vessels get broken. Happens or not? With machines, there is no wastage. Right? So if I bring machines, I'm going to save my cost. Okay, savings in scrap means what? Savings in wastage. Come on, people, now tell me. Did you understand what I said? Hello. You know people who make shoes by their hands. They cut the leather by hand, they shape it, they convert it into shoes. And people like Bata, much company, you think Bata must be making by hand? Huh? Stitching one shoe. Everything happens on machines now. Everything happens on machine in case of Bata. So definitely what? There is some wastage that must be taking place when it is done by hand. And when it is done by machine, no such wastage takes place. Suppose a leather sheet is there. Okay, the person is cutting. Howsoever expert, sometimes, somewhere, something goes wrong. In machine, it doesn't happen. Right? So can I say these are my inflows? Extra savings. Estimated cost of supervision. Oops. Costs. Correct? Na? Machine would okay, machine will work on their own, but quality management supervision has to be there. Right? And see, very important. Savings and wages. Guys, we are going for automation now. So why we will pay the wages? Now we'll say what will we do with workers? I lay them off, right? Now workers will be laid off, so we'll be saving this. Right? Okay. That's it. Question is over. So now you tell me whether we should bring this machine or we should not. Sorry. Depreciation charge is on straight line basis. Tax rate is 30%. You have to calculate ARR, present value index. Hello guys, present value index means only PI, profitability index. Okay. KO is 10%. And the present value of 1 at 10% for 5 years is given and 6 years is given. So you just have to use this file. No changes, please. Okay. See, friends, understand the whole question you go through, you are nowhere given, even the sales. Sir, we want to prepare income statements. Sir. Tell us sales, tell us variable cost, tell us fixed cost. Not given, dear friends, not given. Why not given? Because by changing the method of production, probably sales is not going to change. What you have to understand, by bringing the machine, there is some savings happening. By bringing that machine, there are some savings happening, some cost happening. That saving should cover my cost. Then I will get the machine. Otherwise, I will not get the machine and say, let it happen by labor only. Did you understand what I said? Okay. So let's see. Okay. See. Fill up some numbers over here, please. See. First, we'll write the cost of the machine. PVCA. Machine number 18. 18. Yeah. Cost of the machine 1,50,000 and 2,40,000. Okay. Cash inflow. See, savings in scrap are how much? 10,000 scrap, or I'll say wastage. 10,000, 15,000. So this is like my inflows. These are my inflows. Additional money I will enjoy. Savings in wages. 90,000, 1,20,000. Take a total. This is 1 lakh. This is 135. So guys, because of bringing machine, I'm saving this much money. These are my gross savings. So without doing anything, what will happen, guys? I'll enjoy this much extra cash inflow. Without doing anything, I'll enjoy this much extra cash inflow. But am I going to enjoy all this cash inflow? No, because I'm bringing machine. As there is some saving, there is some extra cost also. Okay, what is that extra cost? See, maintenance cost. How much is the maintenance cost? 7,000 and 11,000. Okay. How much extra we are spending on indirect material? 6,000, 8,000. On supervision, how much will be spending? 12,000, 16,000. Okay, fine. So now see, this will be the net cash flow in my hand before tax. Okay. So 7 and 6, 13, 39, 20, 25. So 1 lakh minus 25 would be 75,000. And this 135 minus 11 minus 8 minus 16 gives me 1 lakh. See, now this is what all extra I have done to arrive at what? Cash flow before tax. There onwards, what will happen? Our step number 4, our station number 4 will continue. No sales, no change in variable cost, no change in fixed cost, nothing doing. After that, I get this cash flow before tax. Everything remains same. So this is my extra cash flow before tax. What I have to make sure from the extra cash flow after tax, I should be able to cover my cost of the asset. So less depreciation. Yes, we'll calculate over here. Straight line method you have to follow. Right? Achha, have they told anything about their salvage values of these machines? No way. So 1,50,000 divided by 5 years. 30,000 over here, and 2,40,000 divided by 6 years over here, 40,000 over here. Okay, 75 minus 30, 45, 1 lakh minus 40, 60. Less tax. Tax rate is how much? 30% tax at 30%. So 45,000 into 30% gave me 13,500 minus equal to I get 31,500 MPAT. In that I will add back the depreciation of 30,000. So I get 61,500 as CFAT. And this is readily given in the question, no? 5 years it is 3.79. And for 6 years it is 4.354. Okay, 61,500 into 3.79 gives me PVCI of 2,33,085. I'll work out on this side now. 60,000 into 30%, 18,000 minus equal to 42,000. Add up the depreciation was how much? 40,000. Into 4.354. 357,028. Okay, friends, we are done with this. What are we asked to calculate? We are asked to calculate average rate of return. Okay, ARR. What is ARR? Average NPAT upon what? Actually, are we given any scrap value over here? No. So can I take original investment as it is? Yes, we can take original investment as it is. So divided by original investment. So here average impact, how much should I take, guys? 31,500 and 42,000 divided by 150 into 100, and here it will be 42,000 divided by how much? 240. Answers, please. 31,500 divided by 150 percentage. 21%. Yes. And 42,000 divided by 240 percentages. Push. 42,000 divided by 40%. 17.5. Yeah, 17.5%. Okay. Other than that, what were we asked for? Profitability index. Calculate profitability index. PVCI upon PVC. Oh, hello people. This average impact of 31,500 is understood. I have got a wild suggestion, sir. Sir, 31,500 should be divided by 5. 31,500 is your annual income, annual impact. So no, sir. We want to do total impact of 5 years divided by 5. You know what you should do? 31,500 you should add 5 times. Then divided by 5. When you have a lot of time in exam, you can do all this stuff. Okay. It will come back to 31,500. What do I do, people? Now people ask such questions. Yeah. So calculate. Come on. PVCI 33,085 upon 150. 1.55? Yes, 1.55. And over here, 357,028 divided by 240. 1.49 now, 1.487, so 1.49, right, people? Okay, what are we told? Evaluate the alternatives according to this. So what would you say? I think both method we should select machine X only. Conclusion. Select machine X since it has higher ARR and profitability index. That's it. Those who are done can go to question number 12. Huh? And this just to give you overview of the sum. Screenshot at the end we can take for the whole chapter. Done, people? Writing something, Kavya? Done, na? Kavya, first lecture, by any chance other than English, are you understanding anything? You're understanding what is this all happening? You learned capital budgeting earlier also, it seems. No? Then like normal people over here have few 5 senses. Sometimes they tell me that I have 6 senses. I predict what you are going to answer. You have some extra also, 7th, 8th. You're understanding everything. I'm blessed if you're understanding. But I'm surprised. To be very frank. Very good. You must be having good grasping power. Start watching the recorded lectures as well, please. What Rishabh, lame, what lame. This is my only capacity. I can do jokes to this extent, right? Experts are you people, right? Come to class for question number 12. I thought 12 will never come. It is there on the screen. Okay, guys. See, are you listening to me? Everybody out there? It's one important question. It's like a puzzle. Okay. It's like you have to extract few values by understanding the exact formula. Okay. Let's see. See. Now, why 18 and then why then 12? Because 18 sum we talked about what cash flows, right? Because of savings, right? When I save something, I enjoy more cash flows. Yes or no? There are two ways of increasing cash flows. It's increase your income or what? Decrease your cost or start saving. So with more savings, you enjoy more inflow. So guys, this annual savings and cost would be CF beating up cash flow before taxes. You agree, guys? Hello? Want me to show the solution again for see, we might be lagging back, but we are not speeding up. Huh? Don't worry, we missed it extra, but we will not rush. Okay. See, all these savings and all this cost led you where? It led you to cash flow before tax only. Agree? So now question is telling you annual savings in cost. So that can I say that is an extra cash flow before tax to me? Sure, everyone out there able to understand what I talk? Okay, okay. Back to the question. So this is CFBT. Okay. You remember, guys? Again, to the here over. Let's go to our stations. Let's go to the railway will be now used extensively. See, we are here, CFBT. From that, what I have to subtract? Depreciation. Let's do one thing. Suppose CFBT is 100, I subtract depreciation of 40. How much is left? 60. Suppose tax is nil. How much will be left? 60. I add back depreciation, what will happen? Will it be same? Understood my point of view? If depreciation is nil, what is going to happen? I'm so sorry. If tax rate is nil, what is happening? CFBT and CFAT is same. Understood this point? Now let's go to the question. I'll remove that later on. One. Question number 12. Question number 12. Okay. Read the question till the end, guys. No tax rate is given. So CFBT itself will become what? CFAT. And I'll write since no tax. Okay. Useful life is 4 years. Okay, again I'll link you. Don't ask where is useless life. Useful life is life of the project. IRR is given, friends. Profitability index is also given. Salvage is given. 0. Okay. Calculate. Cost of the project. Project's cost means what, guys? PVCU. Initial investment they are asking for. Payback period. Cost of capital. KO and NPV. And they are giving you some discounting factors. Okay. So we will use the information that is available to us. Let's start. What we are given numbers wise, we know profitability index. Okay, so let's utilize profitability index is given 1.064. True, friends. You know the formula for profitability index? PVCI upon PVCO. Perfect, right? As more expressive people are, I'm very happy. Till the end of the lecture, also they are participating, knowing that 4 minutes are left. Some is not going to get over in 4 minutes. Some people, oh my God, need to study extra. And some people, it's okay, sir. Good, we will understand the things. Okay. So people are like PVCI, PVCO. That is nice to see how. Oh, listen, Shiksha, you have any idea about PVCI? No, but how is it calculated? That's where, see, listen, very important. Annual CPAC multiplied by present value annuity factor of KO of how many years? What's the life of the asset? 4 years. Discovery. This is how we calculate PVCI. What say people? This you did not know. This you knew now. You don't know. Upon PVCO is equal to what? 1.064. Okay. Out of this, do we know anything? I think annual CPAC we know. 60,000. Okay, we substitute whatever we know. Do we know the KO? We don't know. What we know is IRR. Limit. So PVAF of KO of 4 years. For that matter, we don't know PVCO also. 1.064. So see, by using profitability index, we could reach only to here. That's it. It's okay. It's okay, right? What is another information available to us? IRR is available to us. IRR. Okay. So let's tap on IRR. Let's tap on IRR. How do you calculate IRR? Do you know? Or like how this IRR comes? IRR is given 15%. What happens? At IRR, NPV is 0. What's it, people? Agree? Okay. Therefore, PVCI is equal to PVCO. Now the very important question, how this PVCI comes? It's in IRR, no? So it will be annual CFAT multiplied by present value additive factor of IRR. What's it, guys? You understand this difference between what I have written? Here it's present value additive factor of KO. But when I talk about IRR method, it is discounted at IRR itself. People, do you understand? Sure. Right? Okay. Do we know IRR? It's written on the screen. 15%. Correct? Ah. Okay. So we are quite close to getting PVCO now. If I get PVCO, I can substitute and get KO also. That's it. Okay. So annual CFAT as we discussed. How much? 60,000. Ah. This one. 60,000 into IRR is 15%, guys. So life of the asset is 4 years. So 15% total. Given in question, 0.869 plus 0.756 plus 0.658 plus 0.572. What is your answer? 2.855 is equal to PVCO. We are there, close. PVCO is equal to 171,300. What's it, guys? Did you get this idea? Now tell me with this answer. First thing, we got the answer of initial investment that is asked in the question. PVC. Secondly, now this formula written at the top, is it now has become utilizable? Okay, so I will copy this formula back over here. What it says, let me read it. 60,000 into PVAF of KO for 4 years. Guys, PVAF IRR is 4 years. You just write over here also. Divided by PVCO is equal to 1.064. 1.06. Correct? Now I can write what PVCO is equal to 171,300. I got it. Okay, so I substitute it now. 60,000 to PVAF of KO for 4 years upon 171,300 is equal to 1.064. Therefore, PVAF of KO for 4 years is equal to 1.064 into 171,300 upon 60,000. Solve this. I got it. 3.03772. How we will proceed, but from this, can we get a hint of KO, guys? Huh? How? We'll take a total, no? We'll take a total of all these factors, no? Right now. 15 we have done. You what say? You guys are answering me? 12%? Okay, let me check the total of 12%. Let me check the total of 12%. 12% factors 0.893, 0.797, 0.712 plus 0.636. 3.038. Wow, matching. This is approximately 3.03038 only, no? Right? You will write but PVAF of 12% for 4 years is 3.038. Therefore, discovery KO is equal to 12%. Wow. Guys, take a look at the question. Things which we are supposed to find and things which we have got. Okay. Let's have a quick look at the question. Cost we got. KO we got. Payback period, very easy. I think we have enough components to get payback period. Remember how to calculate payback period? Payback period is initial investment of an annual CPAT. Correct? Initial investment, I suppose we found out earlier, 171,300. 171,300 divided by annual CPAT, we know 60,000. 171,300 divided by 60,000. 2.855, so 2.86 years. Yeah. So now what is left? Net present value. Net present value. PVCI minus PVC. Answer ready, guys. Wait a minute. PVCI will come at what? KO, na? PVCI has to come at KO. So PVCI will come. PVCI would be annual CPAT to present value unity factor of KO minus PVC was how much? 171,300. So 60,000 into KO's factor you told me na 3.038 minus 171. So 60,000 into 3.038 gave me 180 to 280. Minus 171. We get a 10,980 guys. 10,980. That's it, done. We are done for the day, guys. So those who are waiting for screenshot, please be there. The whole world will leave me, but Someshwar will always give me the company till the end. Because Someshwar must not have taken screenshot till now. Right now, Someshwar. Yes, people. Bye bye. Thank you so much. Those who are living can absolutely. Those who can still bear me for some more time, like stupidity. What is that? 58. Someshwar. Zoom level. Guide me how much zoom should I do? Correct. 58. Okay. This boy. Hello, people. You understood the last sum or not? Understood, na? With your kind permission, should I scroll to the next page? Yes, people, those who are living, no problem. If you have no screenshots to be taken, I'll scroll to the next. Someshwar done, Ray. Done, Someshwar. Someshwar, you complete your book now. Done, friends. Okay. Yeah. Oh, Someshwar is of very helping nature. Someshwar, you share the screenshot in the group also. Oh, so everybody is like, I will get confident. Someshwar is there. Okay, okay. That is the thing. Got it. Screenshot, man. Okay. Annual savings in cost isn't after tax. What's say guys? Ganesh is asking. Annual savings in cost isn't after tax. How come? Is it written that it is after tax? If I tomorrow write that this is my sales, so how do I say that it is after tax? Sales are always sales. Then we subtract variable cost. Annual isn't net. Are you crazy? Annual means net. In the same net, it should be tied and hung to the ceiling. Annual means yearly, right? Annual doesn't mean net. If I say my annual salary is this, my annual expenditure is this, does that mean it's a net value? And net and gross, but I think the concepts are before tax and after tax. Concept is not net income and gross income. So when I save something, is the cash that I save. No marking in the 12th question. I just read it, I suppose. Okay. I thought I just read it, but as usual, I scribbled something. Okay. Done, friends. Any more questions? No? Sure. you, Guruji. Have a great day. Thank you, Moin. Huh. Okay, okay. Chalo. Then we will end the lecture, right? Tavia, please complete all your viewing as quick as possible, huh? Right? Okay. Chalo. Bye, people. Have a great time. See you in the next lecture. Bye.